Slide 1. Financial Statement Analysis for Decision Making. Welcome to Financial Statement Analysis for Decision Making. This chapter equips BA Economics students with analytical tools to evaluate financial statements. We will learn techniques for assessing profitability, liquidity, solvency, and risk, enabling strategic decisions via ratio and trend analysis. Slide 2. Agenda. This agenda outlines the topics in this chapter. We cover vertical and horizontal analysis, common size statements, and key ratios for liquidity and solvency. We explore DuPont models. We examine comprehensive cash flow analysis, trends, credit techniques, red flags, sector indicators. Slide 3. Vertical analysis. Vertical analysis presents each financial statement line item as a percentage of a selected base, typically revenue for income statements or total assets for balance sheets, within the same period. By standardizing items relative to a common denominator, vertical analysis enables meaningful comparisons of structure across various companies and over time periods. Slide 4. Horizontal analysis. Horizontal analysis evaluates changes in financial statement line items by comparing balances across multiple periods and calculating percentage variations. This method uncovers performance trends, growth patterns, volatility in revenues, expenses, and asset balances. By tracking these metrics over time, analysts can identify anomalies, assess trajectories, and inform strategic decision-making. Slide 5. Common size statements. Common size statements present line items as percentages of a base figure to enhance comparability. In income statements, lines are percentages of revenue. In balance sheets, items are percentages of total assets. Standardizing formats ensures analysis remains consistent across different firms. Slide 6. Liquidity ratios. Liquidity ratios measure a company's ability to meet short-term obligations. Key ratios include the current ratio, current assets over current liabilities, and the quick ratio, current assets minus inventory over current liabilities. These metrics assess ability to meet obligations and cash conversion efficiency. Slide 7. Solvency ratios. Solvency ratios evaluate a company's financial stability and debt management. Common measures include the debt-to-equity ratio, total debt over shareholders' equity, and the interest coverage ratio, earnings before interest and taxes divided by interest expense. These ratios gauge leverage and debt servicing ability. Slide 8. Profitability ratios. Profitability ratios evaluate a company's earnings generation relative to sales or assets. Key metrics include gross profit margin, gross profit over revenue, and return on equity, net income over shareholders' equity. These ratios measure overall operational efficiency and profitability trends annually over time. Slide 9. DuPont analysis. DuPont analysis decomposes return on equity into three components: profit margin, asset turnover, and leverage. By multiplying net profit margin by asset turnover and equity multiplier, this framework reveals which drivers contribute to ROE and identifies areas for performance improvement. Slide 10. DuPont analysis, extended model. The extended DuPont model breaks ROE into net profit margin, asset turnover, equity multiplier, and tax impact. This decomposition enables deeper insight into tax efficiency and operating leverage. Analysts use this approach to optimize financial structure and maximize shareholder returns. Slide 11. Cash flow statement. Analysis, cash flow statement analysis evaluates the quality of earnings by examining operating, investing, and financing activities. Analysts focus on cash from operations, free cash flow, and cash conversion ratios. This analysis highlights liquidity generation, capital expenditure requirements, and financing dependencies. Slide 12. Trend analysis. Trend analysis examines financial statement data across multiple periods to identify patterns, growth rates, and fluctuations. By calculating percentage changes over time, analysts detect accelerations or decelerations. This method enhances forecasts, supports strategic planning, and reveals financial strengths or weaknesses. Slide 13. Credit analysis techniques. Credit analysis techniques assess a borrower's creditworthiness and default risk. Analysts evaluate financial ratios, cash flow projections, collateral quality, and qualitative factors such as management, industry trends, and macroeconomics. This comprehensive process determines credit limits, interest rates, and appropriate covenants. Slide 14. Red flags in financial reports. Red flags in financial reports indicate potential misstatements or financial distress. Key indicators include inconsistent revenue recognition patterns, unexplained inventory fluctuations, weakened cash flows, recurring losses, and atypical related party transactions. By vigilantly monitoring these warning signals, analysts can initiate comprehensive investigations, validate disclosures, and enhance confidence in financial statement reliability. Slide 15. Sector-specific financial indicators. Sector-specific financial indicators vary with industry characteristics. For manufacturing, metrics include inventory turnover and capacity utilization. Retail relies on sales growth and inventory days. Banking emphasizes net interest margin and non-performing asset ratios. Analysts select relevant indicators to benchmark peers. Slide 16. Sector-specific financial indicators. Continued. In technology, indicators include R&D expense ratios, revenue per employee, and user growth metrics. Energy focuses on production costs, reserves replacement ratios, and EBITDA per barrel. Real estate emphasizes earnings per square foot and occupancy rates. Sector context informs analysis. Slide 17. Financial analysis in investment decisions. Financial analysis guides investment decisions by assessing risk and return. Investors apply ratio benchmarks, discounted cash flow models, and DCF valuations to estimate intrinsic value. Scenario analysis evaluates outcomes under different assumptions. This approach supports portfolio construction and asset allocation. Slide 18. Financial analysis in lending decisions. In lending decisions, financial analysis assesses credit risk and collateral adequacy. Analysts examine cash flow projections, debt service ratios, and covenant compliance. Stress tests simulate adverse scenarios to evaluate resilience. This evaluation informs loan terms, pricing, covenants, and monitoring processes. Slide 19. Integrated Financial Analysis Framework. An integrated analysis framework synthesizes ratio, trend, cash flow, and credit analyses into a comprehensive model. It aligns quantitative metrics with qualitative factors, including management quality, governance practices, industry dynamics, macroeconomic trends, and incorporates risk assessments, strategic projections, and scenario planning. This holistic approach enables informed, long-term decision-making and stakeholder confidence. Slide 20. Key takeaways. Key takeaways include mastery of vertical, horizontal, and common size analyses, expertise in liquidity, solvency, and profitability ratios, in DuPont, cash flow, and trend analyses, familiarity with credit techniques, red flags and sector indicators, and application in investment and lending decisions.